Good afternoon, good evening. It is December 2nd, second trading day in December, and the market was up today. The S&P was up 0.25%. The NASDAQ bounced back from yesterday with 0.59 gains. The Russell was down a little bit. Oil prices did sell off. Oil was rallying yesterday, but per barrel prices really went down today. What also happened was interest rates went up quite a bit yesterday and they went back down today. Interesting. Now, what's the market going to do for the rest of the month? That is a mystery of sorts. I think it's going to go up because we have some big factors. They're going to help asset prices. One, interest rates are expected to go up over the next couple of years. With low interest rates, we're going to have higher asset prices. Stocks are an asset, and therefore stocks should rise. That's not good enough. We got to pick the right stocks. And that's what this live stream is about. Picking good businesses is a good idea, but it's not always a perfect recipe. Hey, it's a great company. I'm going to buy the stock. When you buy the stock is really important. Finding out what the intrinsic value of a stock is based on the value of that company's future profits, the value of that company's future cash flows is a very important metric. So that way we know, are we buying at a discount or are we paying a premium for a stock? Has the stock been in a rally mode? Has it been sold off and been ignored by the market? There's a lot of factors to consider, but trying to get into a process that's good for you is a really good idea. I try to simplify my process because stock investing is difficult. It's very rewarding, make a lot of money, but you need to really refine your process, keep it simple, and then follow it. So that's what we're going to cover today. We're going to cover stocks. We're going to take it nice and slow, really try to look at the companies that come up very carefully, and hopefully learn something from today's live stream. We had a lot of earnings out today, so I've got plenty of stocks that I can go over. CrowdStrike announced after the market closed, Marvell, Pure Storage, OKTA, GitLab, and Box. All those are interesting to me for one reason or another. So those are the stocks that I could cover. Now, I would like to know what you want me to cover. If you're a member of this channel, you can put a stock symbol in the chat and I will put it on the list and I will cover that. If you're not a member, no big deal. You can buy a $5 super chat. I'll cover a stock of your choice. And if you would, as an alternative, you could also become a member on the fly. I put the link on the chat so you can take a look and see if it's something you'd like to do. It'd be great to have you as a member. I think you'll get a lot of value. So where should I start? Well, we talked about the market where it's been. As we look at the rest of the month of December, December tends to be a month where you see some profit taking, and in some cases, some investors will harvest their losses so they can match them up with other gains. So you tend to see some early in the month activity, but we usually have what they call a Santa Claus rally toward the end of the month. People want to get into particular stocks so they can position themselves well for 2026. And as I invest, I'm keeping an eye on 2026. I'm adjusting my portfolio. I put out a video to super investors today where I talked about the two stocks that I did sell off my portfolio, and as well as the stocks that I'm buying. And I bought some stocks yesterday and today. But I'm adjusting my portfolio, thinking of 2026 and where I want to be. And it's been a really good year. I've got a good rate of appreciation, overall performance. I'm above 30% overall. So I'm beating the S&P and doing well. How could I repeat that for 2026? That is what I'm working on. So looks like we've got a comment. Is it Entian? You are interested in Adobe? I could cover that. Put in a $5 super chatter, become a member, and we can cover Adobe software business. I can do a full valuation on Adobe and so forth. All right. So as mentioned, we had earnings today. And during the day, what did we see from which sectors were picking up the most investment, right? It looks like Apple picked up a nice bid, and I think they're at an all-time high. NVIDIA went higher, and Meta went higher. Not a big surprise. I think that's been sold off. Palantir went higher. And the software space picked up a nice bid in Salesforce, Intuit, Uber. The semiconductor equipment and material space looks good. Some semiconductor worked. Broadcom gave up some of those big gains it's been accumulating in 2025. Amazon went up slightly. Amazon was up nicely yesterday, so that looks good. Financials, we've got a little bit of green and a little bit of red. Energy is real red. It was nice and green yesterday, but when oil prices go down, energy goes down because they don't make as much money every time they pump out oil. Consumer staples, Walmart, Costco went up, but others went down. Utilities went down. So it wasn't a day for the safe stocks. It was a day for semiconductor, some consumer electronics, Apple, and so forth. So not a big giant day, just a day where something worked and some sectors did not work. So as mentioned, we've had a good number of earnings, and CrowdStrike is probably the most interesting one to take a look at. So I'm going to start there, and we'll get started with CrowdStrike. So CrowdStrike, they do cybersecurity software. Of course, that's really important. CrowdStrike, a couple of years ago, had this huge outage, if you recall. A lot of computers went down, and it caused big disruptions. Airlines, all kinds of businesses were disrupted. These guys do software as a service. Over the 1 year, the stock's up nicely, 49%. 5 year, 250%. So this has been a really good stock. Very good stock. $129 billion in market cap. Revenues are 4.3. So that is an expensive ratio. Why is it expensive? A growth stock is typically priced, 10 to 20 times sales. If you get above that kind of range, you're getting up there to the stratosphere. And this one's 30 times sales. So you'd have to multiply this revenue number by 30 to get to its market cap. That is an expensive ratio. Forward PE of 122, expensive. These guys better be growing incredibly to substantiate or justify a metric of a forward PE being 122. That's really expensive. So when we look at growth, let's take a look at that. I'm going to look at it here. So the growth rate of CrowdStrike, we're in the year that's going to end January 31st, 2026, 23%. Well, that's good. It's just not incredible. Palantir is incredible. Other businesses that are growing 60, 80% on a number that's around this size, that's incredible. This is okay. This is good. But it's not worth 30 times sales for a 23.4% revenue growth. They're going to continue to grow. That's very good. And their profitability is going to continue to expand. But their PE is going to stay persistently expensive, 63. What is an expensive PE? What is not an expensive PE? The S&P roughly has a PE of 26 right now. So if you want to fit into what is the average PE for the S&P, mid-20s. If you're above that, you better be growing a lot. The higher you are above mid-20s, the higher growth you better have. And again, low 20s, that's good, but it's not great. So these ratios look expensive. CrowdStrike happens to be what I think is a kind of a favorite stock, a popular stock. Investors like CrowdStrike, and I can understand they're growing quite a bit. But other businesses in cybersecurity are growing just as well, but their valuations are different. They're better. They're less expensive. They're discounted. Let's take a look and see why investors are really buying this stock up. Now, the stock is under some pressure. They announced their earnings and they logged higher sales, but I think investors are probably revaluing the company and realizing, whoa, this is an expensive company. These ratios are really expensive. Yeah, they are. So maybe they're realizing that and saying, we better sell this stock. So let me take a look at my valuation on CrowdStrike, show you where I think. So to me, CrowdStrike's a very expensive stock. It is 62%, priced 62% too high. As I showed, a lot of their ratios are expensive. And I'm going to update this because we've got some fresh numbers. So let me try to get those fresh numbers and then I'll update it for you guys here on the stream. Now, if you invest in a company, minimum homework that you need to do is look at the stock at every earnings report. Second, you pick when. It has to be twice a quarter, twice every 3 months. You got to research your companies and make sure you're staying on top of what's going on with the business. You're a part owner. You got to keep an eye on the business. Are they accomplishing what they're aiming to do? Are they falling behind? Is competition eating more market share than they would like? Are they beating the competition? That kind of thing should be done. And with CrowdStrike, I update it because it's an interesting stock and it comes up quite a bit. But it looks like they did provide good earnings for the current quarter. And when I look at the quarterly, they grew in the quarter by 22%. And again, 22% is good. It's a good number. Their free cash flow, which is an important measure of how much value they're creating, expanded. It didn't grow a whole lot, but let's go ahead and update that number. So it went up to $1,173,000,000, growing by 22% or 20%, excuse me. And that is fine there. So that gives me an intrinsic value of 49 billion. Now I'm going to look at the cash on the balance sheet and how much debt they have. The balance sheet shows that they have $4,800,000,000 and they have debt of $818 million. So on cash, like the current value of their cash flows is 58% below its current stock price. The value per share based on the free cash flows that I expect in the future is only $216 per share, but you have to buy shares at $516. So this is an expensive stock. When we look at the earnings per share, another way of valuing the company is based on the profits they're going to produce. We're going to use next year's number. It's 486. I'm going to give them a P of 36. That's the limit. I'm not going to go higher. They're growing that number well by 25. That's fine. So this stock is just priced too high. For some investors, this might be a good investment. For me, it's not. I can find better value, better discount rates. At some point, this stock is going to revert back to its intrinsic value. After hours, it's selling off a little bit, just a tiny bit. Looks like the market or investors were disappointed in some way, or maybe they just revalued the company and realized this is just a really expensive stock. We'll see. We'll see how it performs over the next couple weeks, and how has it done after other earnings reports. Let's take a look at that. So we're sitting here. It did go up higher during normal trading hours, but 3 months ago would have been the beginning of September, and it rallied after its earnings, and it rallied quite well. So interesting. We'll see if it rallies after these earnings, if it becomes a popular stock to buy. So that's CrowdStrike. It's under pressure. I think it's priced too high, and absolutely would be a sell in my book. But that's the way I invest. And everything that I do on my channel is just research. It's for you to consider, just one more opinion, but never financial advice. Remember, all decisions are made by you on your investments, your portfolio, and I wish you well. I hope you pick stocks that are good for you, that help you grow your wealth over time. So CrowdStrike in the books, fading in after hours, and we'll see how it performs over the coming weeks and months. I'm just going to make myself a quick note, and we'll move on to the next one. So the next company that announced, I'm going in order of biggest market cap to smallest market cap, is Marvell. And the market really liked what they saw. Marvell is a semiconductor company, and they produce semiconductors that go into the data center. So a lot of their chips are going into the data center. So they're probably doing really well. So it looks like in their announcement, they swing to a profit and they have good demand. So they probably have a very good backlog of orders for their semiconductors that'll go into that data center. Good. This stock hasn't been fully in rally mode. In fact, you're just breaking even if you owned it for a year. But after today, you'll be up quite a bit more. You'll still be underperforming the S&P over the 1 year. S&P is probably up 14% over the 1 year. So you could see that this stock had been kind of weighed down, which I thought was a surprise because data center spend is so high. And other semiconductor companies like NVIDIA and Broadcom have just been, their stock prices have been flying up. This one, not so much. The market cap for Marvell is $80 billion. And when we go and compare it to its revenue, you're paying about 11 times revenue. Not bad if they're growing, especially. Not bad. PE of 30. We'll see how they're growing. If they're growing, not a big deal. If they're not growing, too expensive. When we look at their growth, let's take a look at that. We have 32 analysts covering this stock. They think it's fairly priced at the current price levels before you get that 10% pop. And this business has been growing nicely and is expected. The year we're in is going to end February 1st, 2026. And they're in a really nice growth cycle, 44%. After that, they'll grow at 16, 18, 19. And a good number of analysts are putting in their research to form that consensus forecast on revenue. Those are good revenue numbers. Earnings per share is going to expand faster than revenue. That looks terrific. So that looks good. And the PE ratio will drop to 17. So this is a smaller semiconductor company and might be discounted. I have a valuation going on Marvell. So why don't we head over there and I will update my valuation on Marvell and see if this stock is priced at a discount or at a premium. When I previously looked at Marvell, it was priced, I believe, at a premium, but let's see what's going on. Yeah, as it stands, it was priced at a premium. Let's update this. All right, so free cash flow in the trailing 12 months. Let's take a look. So the free cash flow over the trailing 12 months for Marvell is $1,581,000,000. It's growing at about 14%. That's fine. The initial year, I'm growing it by 1.2, and that might be a 1.3 because I showed you how they were growing really fast in the current year. So let's go ahead and add a little bit there. So the intrinsic value, the current value of the cash flows I expect in the future and net present value is $71.3 billion. Now I'm going to add cash and take away debt. And the cash balance is $2,710,000,000. And the debt is $4,047,000,000. That's the same debt. So on cash, before it rallies up 10%, this stock's already 13% too expensive. Shares are really worth $80 a share. When the market closed, they were selling at 93, and then tomorrow they're going to sell at an even higher price. So it's still looking a little expensive. Let's see how earnings per share and the valuation of earnings per share look for Marvell. So this is the same number. They're growing by a little bit, so maybe we'll give them a 28 and increase this to 18. So if you just value a company based on earnings per share, which is not what I do, I like cash flows to be the main valuation basis for a stock, you could probably get to a discount. But when you combine the two and when it blend the two, where the value based on cash flows is 2/3 of the blend, it's priced 1% too high. And tomorrow it's going to run up like 9-10%. So Marvell is not looking like a good opportunity for me. Right now, semiconductor is expensive, but I can get NVIDIA for a nice 10% discount right now. I'd rather buy NVIDIA than Marvell. No disrespect to Marvell, but it's just not a very well-known company. And I don't know that it'll ever attract a big population of investors. But they had good earnings. They had really good earnings. So congratulations to Marvell, to investors of Marvell. It looks like it's having a good night, and it's going to open up higher tomorrow. That is Marvell, semiconductor company, having a good night. Bo, good to see you. It is great to see you, sir. It is the same process I use for myself. So to kind of give you a general, explanation of my process. So I try to invest in industries that I understand and I like, and I find attractive. What makes an industry attractive? It has to be an industry, for example, Meta. It has very good revenue growth. So the revenue growth is there. It makes it an attractive business, but it doesn't stop there. The company, I have to understand, is it really profitable or is it just barely making any money? Obviously, if it's very profitable and it's growing, it's a really valuable entity. One last thing, can it defend its turf? Can it defend its marketplace? It can either defend it by having proprietary technology and patents on that technology, so its competitors can't just copy something they do, or it could be a network power, a network dominance, where if everybody's on Meta, getting people to migrate from Facebook to a new social app is very difficult because you're not going to get people to cut over. The changeover difficulty is very hard on users. They don't want to move over unless they're family members, friends, and everybody moves over to the new platform. It's very difficult. So the business, I first want to see that it's a very desirable business. Next is value the company based on cash flows and based on profits compared to its current stock price to see, am I buying at a discount or am I buying at a premium? I never buy at a premium, factually. And that's, I try to repeat that, and I try to find stocks when the market just really is frankly wrong. And Meta is a good example. At times, the market's been really wrong, and I made money. The market thought Meta was just terrible, and it sold off the stock to the point where it sold off 76% of the stock price. It took it from being higher than $300 a share down to like below $90 a share. But what didn't change was Meta was still the dominant social app company with Facebook, Instagram, WhatsApp, and they continue to be that company. So this created an awesome opportunity. This was highly discounted, and buying and investing was a great idea. All the dollars, all the capital I put to work there, I'm up 612% on that capital. The market has somewhat of a short memory. It doubts a company, it'll discount it, and I can buy. It doubts the same business, it discounts it, and then I'm able to buy and make more money. And what happened recently? After the earnings, it began to doubt Meta. And if you look at the short term, now I'm making more money. And I bought shares here. On every dip that I just showed you, I bought shares. So my process is to find a great business that's really desirable. It's desirable because it's growing. It has great profitability aspects. It could defend its territory. It could defend its marketplace and actually grow it, go on offense, which Meta's doing. They're growing by 26%. And when you value the company, you're getting it at a discount when you compare what truly makes the value of a business, which is the ability to generate cash flows. That's the principal way a company establishes their value. So if you want to know more, Bo, love to have you on member calls and we can talk through my process. We can talk through your process and we can see how we can become better investors. So that is a quick run through my process. And thanks. Good to see you, Bo. All right. So we covered Meta. Now let me go into something I meant to do. So I've been using stock analysis for well over 2 years. And the reason I like stock analysis is that you don't have a cluttered workspace. And I hate like Yahoo Finance and all these other sites. They just try to put too many things in one place. And they also posterize like a lot of advertisements and just a bunch of like noise. And I just like to get to a good workspace and do my job, which is analyzing companies. The stock analysis is really made for an investor like me. And over the last 2 years, I've pretty much used it on all my videos. You can see that they have what I need to look at a company. We just looked at CrowdStrike as an example. Got all my fundamentals. They have the financials. If you want more history on a company, when you become a premium member, which I've been for some time, you get better history from the company. They also give me good metrics like trailing 12 months, free cash flow. They give me growth rates that I look at when I'm looking at a stock. looks at the right ratios. When you look at statistics, they do a nice job to give me the statistics that I need. One of them being the balance sheet metrics. And the balance sheet metrics are down here. They tell me what my cash balance is, what my debt level is. They give me things like the debt to EBITDA ratio. In this company, I'm not sure why it's not calculating. It typically calculates return on equity, return on assets, that kind of thing gets published there. The forecast is excellent. I really like how they bring in analyst information. Now, I don't go blindly behind analysts. I like doing my own research, but I also like to see what analysts are thinking. It's generally in the right direction. Sometimes analysts are wrong with the rest of the market, but that's seldom. Most of the time, they're probably pointing in the right direction. These guys are saying CrowdStrike's fairly priced. Okay. And that's based on earnings per share. Analysts don't do discounted free cash flow. They take the easy route. They just do earnings per share, which is easier to calculate, easy to report. And if you would like to get on stock analysis, please use my code. I'll get credit for it and you'll get a discount. So right now they're having some sale. You usually get 10% off if you use my discount code. But if you take advantage of their sale, you'll get 20% off because they're having some type of Cyber Monday sale. So if it's something you're interested in doing, I'm going to put a link here. You can go straight to stock analysis and use my sign-up code. I'd appreciate that. And you'll be good to go. Several of you signed up. Thanks for doing that. I hope you get as much value as I've gotten out of stock analysis. I'm a full paid member, been a subscriber because I really like what they're doing over there. They've made the site better and better over time. So good job, stock analysis. All right, let's keep rolling. We've got a good number of stocks to look at that have announced their earnings. And I will keep looking at the chat to see if members want me to look at some stocks, or if non-members want to do a super chat and request a stock, that'd be terrific. All right, the next company we're going to go over is Pure Storage. And they are not having a fun evening. Their stock's down 10%. Now, this is a company that's really gone up in price, 78%, 400%. This is a storage company, data storage. And we're going to look at this company closely because I want to point out a few things. Remember how I like businesses that are growing that are very, very profitable. I'm going to show you how, in the case of Pure Storage and other storage companies, they're not very profitable. So I'm careful with these types of stocks. So Pure Storage is a $31 billion market cap company. They're selling for a little under 10 price to sales. The PE ratio is 42.8, and they're probably growing. And the PE ratio to the naked eye looks okay. Let's take a closer look. Now, when you look at a company, every company has to issue out 3 financial statements. The income statement that tells us how they're operating in that year. Are they selling more product? How much money are they making on the sales they made? How high are their expenses? Those kinds of things. The balance sheet, and the balance sheet's like your credit history. Like when you go apply for a loan, let's say you're buying a house, they want to look at like 2 or 3 years of your earning history. They want to see if you've ever went bankrupt, if you didn't pay back loans. So they look at all your history individually, right? A balance sheet is pretty much where a business, this is their history. They've accumulated cash on the balance sheet, and that accumulates a balance, or they accumulated debt. Well, that's a negative. Or they accumulated other assets or other liabilities. So that's where we go see what has the accumulated value of this business been, or the accumulated liabilities. Then we have a third statement of cash flow. That's the money statement. And that basically clearly outlines in accounting, there's a term called accrual accounting. And it's basically that when a business earns revenue, they can recognize the revenue. When they incur an expense, they recognize the expense. But the cash may be either ahead or behind those transactions. For example, you sold somebody $1 million of product, but they don't pay you for 6 months. So immediately, great, you sold them some stuff, $1 million worth of stuff, but you don't get the cash for 60 days. Statement of cash flows basically just treats cash. Just looks at when you receive the cash or when you spent the cash. It's a very important statement because it's pretty much a simplified way of seeing how much cash is a business producing. You strip away all the accrual accounting, all the adjustments, and investors that like the late, great Charlie Munger didn't like looking at earnings per share because he felt that the management at a company has they have too many levers to make that number change, the earnings per share number. So he liked free cash flow, as most investors do. I do as well. So those are the three financial statements that you'll always see for a business. Back to Pure Storage. And Kurt, I see your comment. Give me a couple minutes and I'm on it. So what I wanted to point out is I like the revenue growth that this company has been executing on. 12.7% revenue growth is good. It's not great. It's not phenomenal, but it's good. Now, great gross margins are 85%, 90%, and Pure Storage is at 69%. That's good. It's on the kind of borderline between good and very good. But their profit margins are low. So they're not very profitable. If I saw 85 and 35 profit margin, that'd be an A score. That'd be great job. But I'm not seeing that. I'm seeing a single digit low profitability. And it's been consistent that way for some time. And actually it was worse about 2 years ago. This is where I have less appreciation for Pure Storage or any of their peers like Pure Storage, and there's others that I can't think of their names right now. So that's where this company has what I call it a low ceiling. They're not as desirable as, let's say, let's look at the gold standard in valuations right now, which is NVIDIA. Now, these guys produce a hardware device, right? Pure Storage does. NVIDIA produces semiconductors. They have to pay for materials and they pay TSM to make the semiconductors, and then they ship out these semiconductors to customers. Now, this is what great looks like. There's 70% gross margins, 53% profit margins. Wow. 53 is a lot of profit. Free cash flow, 41%. So this is what great looks like. And when you compare what Pure Storage is doing, they're nowhere near great. They're not even close. 4%, not good. Throw 15 in there, maybe a 20, and it'd be on the fringe of good. Okay. So this is where the low ceiling compliment or red flag comes in. Now, these companies have been catching a lot of attention because they're part of the data center, and they are growing, no doubt. But they're not making a lot of money. So you can grow your revenue top line, but you're not making a lot of money. So this valuation here, Pure Storage, me show you what I came up with. I create research and videos for members, and I just released a video that actually covered, I thought I had Pure Storage in there. I guess I don't. Nope. And when I value Pure Storage, I just come up short because their free cash flow numbers don't amount to what I need to get to the market cap. This is $550 million of free cash flow. Based on the ceiling I was talking about, they're not very profitable. I'd probably pay 20 times free cash flow minus debt. And do they have any debt? They don't. It actually add about a billion, on top of that. So I'm getting to 11 based on the free cash flow. So it'd be worth roughly $12 billion in market cap to me. Well, they're way above that. It's just way too high of a market cap. The stock has gone up way too high. And chances are this stock's going to revert back to its intrinsic value. It was priced here for a reason. Okay. It was priced at 19 for a reason. Yes, it's had a nice run with the data center being built, but this is the makings of a very painful ride down should I decide to buy this stock. So Pure Storage is having a tough time after it announced earnings. I think investors, again, are revaluing the stock and realizing, whoa, I think this is the first step of many for it to go down. So we'll see where it goes. So that is Pure Storage. It is under pressure in after hours. We'll see where it goes. Good to see you, Kurt. MongoDB or MDB had a huge day. So this one here, Mongo had good earnings, but they weren't like incredible. They were okay. And let's take a look. We'll take a look at Mongo and go through all the steps here. So MongoDB provides a database, and they provide a database in a software as a service model. They host that database. Customers can use it. They can use it in conjunction with their AWS workloads, with Azure workloads. It's a very flexible database. Looking at the 5-year, this stock has seen volatility. At certain times, the market was just in love with this stock, and then it hated it. Oh, man. From here to here, the stock went down, about 80%. It picked itself up, rallied higher, and then again, it came down. It came down to here, went down about 60%. It came down even further here, and it came down to, looks like 70% from its peak. Now it's building one of these runs again. Okay. Is this going to be sustainable? Okay. So let me go through the steps here. So first, the company is call it 33 billion in market cap. Revenues are 2.3. So you're paying a little bit of an expensive price, right? You're paying 14 times sales. Not a big deal. Forward PE is expensive, 74.6. It's expensive. That's a forward PE. The current year, they're not making any money. Okay. Now, these guys are growing. Let's take a look at the growth. 18.69 in the quarter they just announced. And they announced their earnings yesterday after the market closed. Now, that is good revenue growth. It's not great, but it's good. They're a little bit small. They're trailing 12 months. This is for the last 12 months. They're at $2.3 billion. And their revenue growth, almost 21%. Again, that's good. Not quite great. Gross margin, 71.6. They haven't turned a profit yet. I think they have to get the scale, because running a company like this, you have to pay for cloud infrastructure. There's a lot of expense. You have to hire qualified software engineers, people to develop the software, run the software, all that good stuff. And so far, they haven't turned a profit. They haven't had a profit margin. Their free cash flow yield is pretty good, and it has been growing, 15%. When we look at the other metrics, 37 analysts cover this stock, a lot of analysts. And there is a difference in opinion with regards to price targets. You have some analysts that are quite skeptical of the company at 190. Those that really believe in the company are at 500. On average, the stock's fairly priced. As of today's stock price, so after the earnings announced, and the stock did rally higher a lot, like 20, 25%. I have that up here, 22%. Now they're expecting to grow. They're going to grow 17, 18, 17. Very good. And they're going to get profitable. They're going to get profitable. It looks like in the year that we're in, and they close this year, January 31st. As we go into the profit period, their PE is going to stay elevated until they get, I think, bigger revenue size, and then they'll eventually have a reasonable PE. Now, my concern is that this is not incredible growth. This is okay. It's good, but I would have to pay a very high PE to get to this type of revenue growth. Now, I do have a valuation for MongoDB. And looks like my lookups on Google lookups are not working right. Let's give that a refresh. And then we're going to look for MongoDB again. And I think as I speak, after the stock rallied higher, it's priced 25% too high. And MongoDB may catch another, rally higher, maybe. But just take in the fact that MongoDB has been known to have these real wild swings in stock. It'll go up and make investors feel like they're geniuses, up 118%, and then turn around for those that really are long-term investors and just cruelly sell off by 74% and then rally higher and then, really come down. So if you're looking at a stock like this, right, and you're considering buying, maybe you bought here, you were smart enough to buy here, I would definitely be looking for the exit. I would be looking for a good exit plan, because I would hate to be smart enough to buy here, be here, and then stick around too long and then see my investment really go down. Instead, I'd rather just take the gain and then come back and buy at a later date, because this stock has been really volatile. And MongoDB does have some pretty big competition. For example, Microsoft has a big database business. So the larger Mongo gets, the bigger they're going to have to compete against Microsoft and others. So that's MongoDB. Good to see you, Kurt. DJ, good to see you. Snow is reporting tomorrow. So could we expect a stock move like the one we saw with Mongo Database on Snow? So these are similar businesses. It's a good question. Why do I say they're similar? So Mongo, they do a database, right? So businesses will use a database either to create applications with, or to store data, do reporting on it, to store data, and it supports some type of online purpose, that kind of thing. Our friends over at SnowFlake are a data platform. And what SnowFlake is allowing you to do is store data for the purposes of analysis, or it could be purposes similar to a database, but it's really made for the era of cloud infrastructure, where 30, 40 years ago, businesses would buy their own servers, set them up, run the servers, run the software on the servers, maintain all their hardware and infrastructure. And what that ended up being is just a very expensive and process, and it required a lot of employees. Now you have access to AWS as an example from Amazon, and they will run all that infrastructure for you. You'll basically lease it out. It'd be pretty much like buying electricity, right? We're not out creating, generators in our backyards. We buy it from the power company. They invest, they create power, and then we buy it. It's a different way of saying that's how businesses are now going to public cloud infrastructure like AWS and buying the compute, buying all those resources. SnowFlake has created their company to be in line with that new way of compute, the new way of using technology for businesses. So they're playing right in that ballpark. But let's take a look at how SnowFlake is growing, where their stock's been. Now, when SnowFlake came out, boy, a lot of fans, but it sold off quite harshly, and then it rallied higher, and then it came down pretty hard. Oof, painful. Very painful. If you're a long-term investor, you must have been in the fetal position for a while. And at a certain point, it started to really work. Over the 1 year, it's up 50%. Year to date, up 68%. So let's take a look at SnowFlake's financials and see, would I expect that this is going to be something they can sustain from a business perspective? Can they sustain that stock price? Can they continue to grow? And is that stock price going to be going higher? So SnowFlake. So they were up today 3%, up 1% in the after hours. Year to date, up 68%. $89 billion market cap business, $4.1 billion in revenue. So you're paying 21, 22 times sales for the company. That's expensive. Forward PE, expensive. Strong buy. All right, let's take a look at growth. So the growth, we have 40 analysts covering it. Some analysts think stock's too expensive. Some believe it could go higher. They're growing nicely. They're actually growing better than Mongo, by the way. Mongo is growing slower and they were smaller. Mongo is smaller. So that looks pretty good. And SnowFlake should turn a profit in the fiscal year that we're in. Their PE ratio is really high because investors are excited about this growth and they're supposed to sustain that growth. So it looks good. Both of these are software companies. Now, let's take a look at the financials and see what kind of profitability we're seeing out of SnowFlake. I'll go straight to the trailing 12 months. Gross margins, 66.79. They're losing money. And the free cash flow margin is a little better than MongoDB. So if we're going to follow the MongoDB as kind of the example of Mongo just issued out their financials and stock rallied higher. If SnowFlake has good earnings, they should rally higher. When we go into the quarterly, so they're growing at 31% in the quarter. That's a good, when you see an acceleration in growth like this, that's a good sign. They're picking up momentum. That looks good. Okay, so if they can come in and beat expectations and raise guidance, they'll probably rally. Of course, we don't know. We don't know if Snowflake is going to be announcing positive earnings or negative. I don't know. But I can tell you, based on their last, report, it looks like they're doing well. They're picking up momentum. Let me also look at how their profitability is changing. So their profitability is getting a little better on the gross margin line, getting better on the profit margin line, but they're still not making money. Okay. Their free cash flow went down quite a bit. So that's a negative point. So conclusion is Snowflake beats. Maybe it does have a day like MongoDB. If it misses, then they're going to have a horrible day. But what I was hoping for was that Mongo is actually the first software stock this week to announce, and they announced good earnings. And I'm like, okay, well, that might be good for the whole space. But CrowdStrike announced, and they're down a little bit. Marvell is up a lot, but they're not a software company. Now, the other software companies that are announcing OKTA, they're more in like, you can call them security, single sign-on. They're down a little bit. GitLab's down a lot, 9%. That's a software play. And then Box is storage, cloud content management. It's another way of saying storage. And they're down quite a bit. So, not sure. I don't know if DJ, if you own Snowflake. I'm not sure if you're trying to buy Snowflake ahead of its earnings. Let me take a look. And I think they announce after the market closes, but I wanted to double check. Yeah. So tomorrow, Salesforce will announce and Snowflake will announce. Guidewire Software will announce. UiPath will announce. Those are software plays. I think Snowflake is looking pretty good, man. It's looking pretty darn good. The last quarter, they had momentum. It seems like they're in a good place. What they do is in demand. They just got to keep growing. And Mongo did execute a good quarter. They beat expectations. And let's see if Snowflake can do the same. If I was in your shoes, I'd be holding my shares. And I'd consider, especially if the stock's selling off in the trading session tomorrow, I would definitely buy some shares. If I was an owner of Snowflake looking at the numbers. Let me look at the valuation I have for Snowflake. I think I have a valuation for Snowflake. Yeah, I don't have a good valuation for them, but maybe it needs to be updated. Let's update the valuation for Snowflake. Okay, so all right, so I'm going to refer to the data on Snowflake on a screen you guys can't see. So we take a look at what their valuation is. Okay, what's their free cash flow for the most current information? They have 751. And they are growing better than that. So we're going to go with 22 there. We're not growing quite that well. So we're going to go 20 there. So based on cash flow, and I just need to, so this looks pretty close, and that was a little different. So the cash flow can't support their current valuation. And yeah, so that's where I land there. Earnings per share that I expect for the next full year is $1.67. I'll go with a 36 growth rate on that number. 30% is fine. Yeah, you got to really like the valuations, or I should say, if you did the valuation on SnowFlake, you're thinking 5 years down the road. I don't think that far. I'm like, look, I need to see evidence that this business is going to be worth what they're trading for. And I'm using real life numbers here. It's not like I'm making it look one way or the other, but it's just an expensive stock. Okay. So it's expensive like Palantir. Palantir is expensive and it keeps rallying higher. So investors keep buying Palantir and it keeps going higher. SnowFlake it's gotten a lot of investors. It's doing great. I hope you're sitting on a really nice return, but it's an expensive stock. I personally wouldn't buy it. I wouldn't hold it. I think there's other software stocks that have better valuations that I'd rather be in. So thanks for asking, DJ. I hope you found the analysis interesting, and we can definitely look at it again. Tomorrow I'll be streaming with Daryl, but I could definitely look at SnowFlake after hours and do a quick video on it. So good luck on SnowFlake. Fingers crossed they have very, very good earnings and your stock is worth more at the end of the day tomorrow. All right. So we've got a lot of people on. Good to see you guys. Thanks for joining. And let me read DJ's comment. Yeah, I do agree that one thing SnowFlake does have is they created the right data platform for the times where, you have businesses using AWS in a big way, Microsoft Azure, Google Cloud, and SnowFlake gives them a lot of ability to, keep using those public clouds and then bring that data together or give you access points to your own data. That's great. That's very timely. Good idea. And so the business purpose, there's no argument. They're there. I'm just looking at fundamentals and going, okay, it's expensive. All right, good stuff. Good to see you, DJ. Let's move over, pay attention to OKTA. I'm going to close some of these windows here. So OKTA is under pressure. And OKTA, they started their business with single sign-on capabilities. And now they do other things within the identity and cybersecurity area. They've been kind of a steady grower. 1 year, these guys are up a little bit. Year to date, up a little bit. Not a pretty picture when you look at the 5-year. Really underperformed. This is a $4.4 billion market cap company. Revenues, $2.8 billion. And the forward P looks pretty attractive, 23.48. Analysts think there's a discount available. They have good growth, 15.3. Let's take a look at the most recent quarter. This is the quarter they just announced. And the market didn't like what they saw. Interesting. They grew 11.5, which is not out of place, right? They grew by that amount 2 quarters ago. Okay. When we look at their profitability, good top line profit. They have margin already. Very good free cash flow. That looks good. Looking at the trailing 12 months. Looks really good. As they get bigger, they're going to improve these numbers. And OKTA is probably a good acquisition target for probably CrowdStrike or somebody that wants to acquire them. It'd be a really good complemental product to a CrowdStrike or a Palo Alto, or because they already sell cybersecurity. They could go in and say, hey, we'll sell you cybersecurity and identity, where you can do single sign-on for your employees. Totally makes sense. So looking at a forecast for OKTA, we have 37 analysts covering them, and they think this stock is really discounted. That looks like a big discount. They're going to keep growing. Look at that steady growth. Yeah, it looks good. So what is the market not liking about OKTA? So OKTA delivered top and bottom line beats. So why is the stock selling off? Huh. Interesting. All right. So I think I have a valuation on OKTA. Let's update that guy. See what we're dealing with. Yeah, I think they're highly discounted. Okay, we have a new number for free cash flow. I can update that number. Okay, so the free cash flow came in at for the trailing 12 months is 904 million. That's decent growth there. I'm going to grow everything else by 10%. Okay. So that is that. So we'll go with the current cash on the balance sheet, 2.4 billion. And looking at earnings per share for the next full year. $3.71. PE at 25 is fine. Yeah, discounted stock. The market doesn't love it, doesn't like it. I think it's a good stock. And I think they are an acquisition target. Another company can come in and buy them and do a lot of good things with OKTA. Good company, good stock, good valuation. I like OKTA. And it's going to be priced lower tomorrow. So that is OKTA. Making money, growing, and the market doesn't like it. Market didn't like something. What did it not like? Sometimes I think the market's crazy. For example, NVIDIA put up like awesome earnings. Stock sold off. And I can go over 10 companies where earnings look really good. Stock sold off. And I'm like, huh, interesting. Then you see a stock like Mongo. I thought Mongo earnings were good, but they weren't great. They were just good. And the stock went up 22%. Wow. Okay. Guess the market is excited about something as it relates to Mongo. So that is OKTA. That is an opportunity that I'm going to keep an eye on. I like what I'm seeing in OKTA. All right. So what's going on with the chat? Got anything fresh here? Here we go. DJ. Okta has a huge data breach a couple of years ago. Took a while to recover. Yeah, interesting. Yeah. I don't remember the data breach that happened on Okta, but yeah, I could see it happening. And I know Palo Alto maybe already acquired a identity solution, but there's CrowdStrike, Fortinet, Zscaler. Zscaler will probably develop their own, but you have heck, Cisco. Cisco has a cybersecurity business. You could see even one of the big clouds like Google Cloud or Azure. No, actually, Microsoft already has their identity, and probably Amazon has identity already as well. So we'll see. Okta might surprise us and be priced much higher in the future. Might get acquired, might not get acquired. Maybe it fades along the way. Kurt. So GMAB is starting to roll. Let's take a look at GMAB. All right. So Genmab. So they announced about a month ago. So Genmab, a biotechnology company, develops antibody-based products and product candidates for the treatment of cancer and other diseases in Denmark. Okay. So these guys are biotech, healthcare. Year to date. Wow, look at that. These guys are rolling. Yeah, looks good. So it was kind of a trail of tears for investors for a while, but they are rolling. $19.48 billion in market cap, revenue is 3.85. So that doesn't look too expensive. Forward P of 22.39. And analysts think there's still a discount available. So the revenue is growing nicely, seeing kind of a pickup in growth rate. That's encouraging. And we have high gross margins. Man, stupendous. Look at that. That looks really good. So let's see what kind of forecast we're dealing with here. So this company is going to continue to grow. That looks good. Really good. It's not incredible growth, but it's really good. You're going to go 25%, 16, 13, 17 with those margins and profit ratios. It's like huge, man. They're going to be cranking out cash. So their PE ratio is going to be this low. Incredible. Looks good. So I wanted to double check something. This is in US dollars. Good. So Genmab's looking good. Really good. Their stock's going higher. And I think they're discounted. This one here, God dang it, man. Should have bought this stock. Rear view mirror analysis. I should have bought the stock. Now, healthcare, I've got good positions in healthcare. This one certainly worked. It's really working nicely. Still has a discount on it. Go Genmab. I don't know if anybody owns it out there, but it's going higher in after hours. Man, this thing's really working. Last month, up 11%. Yeah. This thing's on its way. And it can come back to, probably going to hit $40, $50 before it ever fades. So it looks great. Thanks for making me aware of that. It's looking really good. Looks like a very good. In my rating would be a buy. I'm not telling anybody to buy it. Do your own, decision making and research. But my research is saying this thing's taken off. I'm probably a little too late to the party, but it might be worth attending for the last hour or two of the party. It's been going on for 2 hours, 3 hours. People are beginning to kind of fade, if you know what I mean. But maybe the party kid just keeps going. The band keeps playing, plenty of food and drink left, and it keeps going higher. I think that's probably what's going to happen. And Genmab, I mean, they're selling into a market where customers are patients, and they really need this particular treatment. So it's looking good. So, DJ, main revenue generating drug patent is expiring soon. I see your comment, and the analysts are saying that their revenue is going to keep growing for like 3 years, going on 4. So I didn't see that in the forecast that's being put out there. That's a good note. I think anybody thinking of investing in Genmab should do their homework and understand which drug is going to go off patent. What will the impact be once that goes off patent? In fact, let's take a look. Let's see. See, some of these news stories will tell us that. So, all right, let's put Gemini to the test here. I could read through all that stuff, but let's ask, when will patents expire for, what's their official name? All right, let's see what Gemini says. So they're set to expire 2029 to 2031. So they've got 4 years, 3.5 years to go. Now, what they should do in the meantime is either create something new or acquire another business with all this cash that's coming in. Not a bad idea. So it still looks good. It looks good from my perspective. Thanks for the note, DJ, because it's good to keep an eye on when these things are going to expire. You're referring to Darzalex. Yeah, here it is. So according to Gemini, it's going to expire between 2029 and 2031. So, and here's another question that came up. Look at that. Go Gemini. What's Genmab's strategy to overcome the patent cliff? So they're trying to develop new drugs and expand existing partnerships. Okay. So they're co-developing with AbbVie, a drug, co-developing with Pfizer. Okay. I think it's still good. Man, our research has been enhanced by Gemini or ChatGPT, or pick your AI app. Perplexity. I think they all get us kind of in the game. They all get us good information. All right. We are humming along. Good stuff tonight, guys. So let me get to the chat. Looks like I'm caught up on chat. Let me move on to GitLab. GitLab. Oh no. Down 9%. So So it looks like they lost money in that quarter, but they did grow their revenue. So GitLab develops software for the software development cycle. And this one's been caught up in the story that, AI is going to reduce the need for as many developers to, in essence, build something. For example, if it took 100 software developers to build a big software application, maybe now it only takes 25. Well, that reduction in headcount on a project would be a reduction in seats and revenues to GitLab. That's the story. Is the story matching up with the sales figures? Let's take a look. Market cap 7.23 billion, revenues 906 million. Forward P is 49. So the quarterly announcement they announced here, their revenue did, you see how the percentage did come down. So that is a little bit of a concern. So it looks like we have a developer on. I just finished developing a portfolio manager desktop app. Cool. So these guys, you have, I don't want to read too much into it, but you did have kind of a loss of momentum to some extent. They have good margins because I've looked at these guys before. 88. This will eventually turn into profit, and free cash flow yield is very good. Very good. But the market is just like not buying in. There's a good portion of software stocks that are put in this highly discounted category. GitLab's there along with others. And 26 analysts cover these guys. The analysts think it's highly discounted. They also expect they're going to keep growing. Pretty good growth rate. This year they're growing by 26%. 2020, 15. Cool. Looks good. Earnings per share is going to grow. That looks good. So the numbers look good, but something in the report is either it missed, it lacks confidence, and investors are selling off. They don't want to take a chance on GitLab. It's a small cap. Are they going to get run over by AI? I don't know. I don't think the fear of AI, doing so many things that people aren't going to have jobs, that's overplayed by substantially. Is AI, like I just used AI Gemini, right? It just saved me some time. I could have gone and researched and searched for the patent forecast of Genmab, and it did it for me. Awesome. Good job, Gemini. You just saved me 15, 20 minutes and the energy, right? So that was value add. Definitely AI is going to add value. I just don't think it's going to be a disruptive force that some people are making it out to be. All right. So that is GitLab. Number 8. Okay, Box. So Box, like 20 years ago, this was cool. It was, now they call it content management, right? You can save your files online and have them accessible and that kind of stuff. That's cool. It was great. But the stock's been okay. I mean, considering this is kind of a slower growth technology company, it's up 62%. It's had a little chop along the way. The 1 year, it's not having a good year. So it's really fading. And I think Box is under threat from the big guys like Google, Microsoft, and AWS. Those guys, I mean, they do storage all day long. They do this stuff all day long. So these guys are probably trying to pick out the small businesses, the individuals that want to use Box. The revenue's slow, slow growth. Although their last quarter was nice. When are they going to announce again? They announced now, after hours. But it looks like the earnings that were announced haven't made it over to stock analysis. But their growth has been good. Judging from the sell-off, their growth wasn't enough to excite investors. They produce free cash flow. This is like a little mini cash cow now. It's going to generate cash nicely. But their future is in question. You have big giant companies that do what these guys do. Are they ever going to grow fast again? No. And I like the fundamentals too, but the future doesn't look good. I wouldn't touch Box for me because I think it's going to be, short-lived. Maybe it has a nice 6-month run and then that's it. Here we've got, they're supposed to grow a little better. I wonder why. I mean, this growth looks pretty darn good, by the way. These numbers look really good. Did they announce like a new product or why are they growing so fast now? So content plus AI. Well, if the forecast is correct, they're going to grow nicely. And they are integrated with all these platforms. So that's good. Yeah, I don't doubt that. They've been around for a while. This growth is impressive. If they're going to grow this fast, I think their stock's going to work. Look at their profit. It's just going to really go up if this is correct. Judging from tonight, they missed. What did the market not like? Market didn't like something, and they're a small cap. So, thanks. Thanks, Bo. Michael Anthony, what's up, man? Yeah, I think GitLab did kind of swing to a loss. They may have taken a write-off or something, and maybe that made investors kind of nervous. Box, I'm not sure what they reported, but the fundamentals on Box look good. Long-term growth looks great. But big picture, I'm like, what's the place for Box in the future? I don't know, because some bigger businesses do exactly what they do here. And if you think about a corporate client, if they're, let's say they do a lot with AWS, they don't want to like form 20 different agreements with vendors, one, for Box for this and another one for that, and another one for this. They want to do as much as they can with one vendor. It simplifies, if anything, the procurement process, and it simplifies, where are we going to get these tools to run our business? Where are we going to get this infrastructure to run our business? Well, the fewer partners you have that have a more all-encompassing platform, the easier, better for the business. And I think Box is one of these small players that is going to constantly be somewhat ruled out because businesses are going to want to go to the big guys. Give you an example. You got Home Depot, right? Now, 40 years ago, Home Depot is a small company. You had hardware stores everywhere. Hey, if you want a hardware store for plumbing, there's one on this side of town. You want a hardware company for carpentry, that part of town. Kitchens, other part of town. And you had these businesses producing and providing the products and services that people needed. Home Depot came out and they're like, hey, we're going to bring a lot of things together in a superstore for home improvement. So you can go there and get cabinets for your kitchen, bathroom. You can get your plumbing, appliances. You can get fasteners, nails. You can get power tools. You can get lumber, gardening. Pretty soon, they put a lot of these small hardware stores out of business. All these mom and pops went away. Why? Because you know what? I'm a homeowner and I'm a real estate investor. I just want to go to Home Depot and find what I need and fix the problem. I don't want to know the 10 different hardware stores and who specializes in what. I just want to go to Home Depot. My wife wanted me to go buy some gardening materials. We're going to do some gardening. Cool. Go to Home Depot, get it done. Sometimes I go to the nursery, but that's an example of what Box is going to deal with. AWS is like Home Depot. They do everything a business could want. They'll do all the collaboration, storage, all this stuff. They do it. Somebody might argue, well, Box is a little bit better, a little different. Point taken. You got it. But again, corporate clients are like me. I just want to go to Home Depot, buy the stuff that I need, take it home or to the property I'm maintaining, get the job done, and we're done. Move on. Time is important to me. And I think Box is going to always have that headwind that it's going to contend with. I would not touch it. My man, Bo, thank you, sir. How do you invest into an early AI company? For example, UiPath. Okay. Company like UiPath, burning cash. Sure. So let me answer the first questions and then we're going to look at Dutch Brothers. And so the first question is, how do I invest in a small company that is coming onto the scene, so to speak? And what am I looking for in order for me to say, yeah, I want to invest? So let me try to think of an example. And I'm thinking, guys, trying to use a real life example. Okay. So Reddit. Okay. Now it's not, I think it's a good example because when you look at, I'm going to go with Reddit. So we know what Reddit does. And you said software, right? So AI company. So do I have a better example than Reddit? 1 second. Yeah, I think Reddit's going to be my best example. We'll just run with Reddit. And we're going to look at UiPath. I think UiPath is going to announce tomorrow. So, okay. So, okay, I invested in Reddit. So Reddit is a company that everybody on this stream probably knows. And let me make sure I understand your question, Bo. Okay. I think I'm going to answer the question and then just keep the feedback coming. If I'm like in line with what you're asking, confirm. If not, correct. Okay. All right. So Reddit. I've known of Reddit for a long time, and we all saw this IPO coming. The IPO'd in 2024. I am careful with IPOs. I try not to get into early because I want, the company to report earnings several times. And then when I get more comfortable around, what they're doing, the data, what's going to be their path to profitability, their path to growth, and all that good stuff. Now, Reddit was not $42 billion at all times, right? Back here, when they were $40 a share, they were 1/5 this valuation. So 1/5 would be $8 billion in market cap. So they were a nice little company. And what did I see that I really liked? Okay, so first, growth. I saw growth. Okay. You can't replace this kind of growth. You can't find it all that easily. You can't, like, I think we saw our friends at Mongo. This stock's up 22%, and their growth is 18.69%. And the market's going crazy. Ooh, man, look at that growth. If you think that's cool, get your head around this. 68%. That is very unique. That's very strong. Okay, you're showing me you can grow, but can you make money and generate cash? And when I got to Reddit, I don't think they were making money just yet. Okay. But they showed me 90% gross margins, 89. This is phenomenal. And now they're profitable, and now they're high free cash flow margin. But I was like dealing with these numbers. Okay. But I saw this number. So back to your question, I'm willing to invest in an AI growth business if they can show me growth, gross margins. You show me growth and gross margins, I'm 90% there. And if I could put together a forecast where the stock is discounted, it's not overplayed, like everybody thinks this thing's going to be the next Google, and it's priced like it's going to be the next Google. All right, well, it might be the next Google, but it might not. And if it's not, I'm going to lose a lot of money. So I'm not going to pay like it's the next Google. I'd rather pay like it's a good company that's going to grow, but I need to have a very big incentive to invest. Show me a good incentive. And the market, as it does often on Reddit, right? So Reddit here cranked up. I was not investing. Okay. But I started to really like the company. I'm like, their fundamentals are looking really good. Then the market decided, you know what? We changed our mind about Reddit. Reddit's bad. And I was like, oh, I'll take shares left and right. I bought shares like crazy. And now I'm sitting on a really big gain. Okay. So I am looking for the next Reddit. I am looking for the next Meta. I am looking for the next Netflix. I am looking for, so you need to, so to your point, I'm willing to invest in small, exciting growth companies that show me growth, gross margins, have a clean balance sheet. The other pieces are important, but not necessary. They don't have to generate free cash flow yet. They don't have to generate profit yet. No problem. The other example would be recently is Astera Labs, similar to Reddit, high growth, high margins, and that one's done well. UiPath, what's the problem with UiPath? Growth. If anything, UiPath should be bursting at the seams. They are truly an AI play. There is no mislead there. They are doing artificial intelligence, agentic AI. They're doing machine learning. They're doing the real deal, AI. Nobody's buying it. They're growing. Nice. This is good growth. Look at these quarters. Pretty lean. Not the greatest growth we've ever seen. Trailing 12 months growing at 8%, and you're small. So this is not exciting. This is not Reddit. Okay. This line's super important with a small business. If a small business shows me that they're cranking up revenue, here's another example. Zscaler. I made good money on Zscaler. And I made it when CrowdStrike was all the craze. But Zscaler, when I bought Zscaler, Zscaler sold off. It was kind of left down here in purgatory. And what I saw was really good growth. And I'm like, man, these guys are growing really well. I think the market has it wrong. And invested, made a really nice return, sold it. So I had the growth and the margins. Margins, 78, 78, 77. These are very good gross margins. Once I had those two things, I was able to buy at the right price. While the market hated the stock, I bought it and I wrote it up. Okay, so it's getting higher though when you take that into account. I don't understand your question. Hopefully I'm going down the right path here. So yeah, so specific to if they're burning cash, that's okay, so long as their balance sheet's good. If you have high growth, the revenue growth, and you have high margins, that's the combo that's pretty damn valuable. Eventually, they're going to be profitable. They're going to generate cash once they establish scale. So last thing I showed on. Okay. So it's going, see this trend here going from 6 to 14. You make a good point. So they're going to announce earnings tomorrow. If we see a 6 to 14 to 20, this stock's going to go bonkers. It's going to go real high. And I'm going to pay attention if they go higher. Because this is a very good number. What does this stock do? Like after the last earnings, what did it do? Yeah. See, the stock really took off. But it came back down. Jeez. Yeah, don't worry about the margins with Path. Not a factor. Yeah, we're good. You have gross margins of 83 and you need 3 years to get to profitability. I'm fine. Just keep growing. You get yourself to a 25 and keep in mind, here's something that's interesting, right? The great Palantir. I think it was Palantir. Yeah, I think it was Palantir. So look at their growth rates. Okay. So here's their annual growth. This will tell us the story. So they were growing fast, slowed down, and then they picked up. And now they're really flying up. Okay. So this one here, so if UiPath kind of had we had to figure out how we were going to grow, and then boom, it starts to accelerate its growth. That's a very good thing. It would be a very good thing to jump on top of and get all over UiPath. So that's an example. And the other example is so Palantir started to grow fast. And there's other examples I can think of, but okay. Cool. You're on Reddit as well. Cool. Very good. So yeah, the chart on UiPath, they announced, what was their earnings announcement? So that revenue growth did grow. That's very good. And they announced on September 3rd. So here's September 3rd. So it didn't do anything crazy immediately, and then it just took off in the October timeframe. But then it decided to sell off hard. The stock's up 14% in the 6 month. Year to date, it's up 12.5. Man, a lot of eyeballs would be on UiPath tomorrow. I'll be on it. So it's going up in after hours. If it goes up, if it starts going higher, I'm probably going to buy the stock, because if it proves that it's going to start growing, I'm in. But it's got to prove it. Tomorrow, if they can come in, let's look at their forecast. Let's see. So the quarter they're going to announce is this one. They're supposed to announce that they're going to grow by 13% and then follow it up with 11.45. Okay. That's good. It's just not like, incredible. It's just okay. Huh. All right. We'll look at UiPath tomorrow, Bo. Oh, okay. So you think UiPath is going to start growing at 60%? If it does, I hope you make $1 million on UiPath. And if it does, if it starts showing that it's going to grow like that, I'll get on that ride. But right now, the forecast is that they're going to grow 13, 11, 11.7, 11. So good stuff, man. Oh, man, that's going to be fun to watch. UiPath. Let's bring it home, UiPath. Let's bring it home. All right, so I think you want to look at Dutch Brothers as well. So let's look at Dutch Brothers. And what's their symbol? Bros, that's right. Okay. So up 9.7, really done well. So this is the coffee business. I mean, you're really doing well if you bought it here about a year ago. We'll see. We'll see if I want to be in too late. So they announce tomorrow after the hours. So I'll give it some time tomorrow. Maybe I'll buy a call option, but maybe not. We'll see. All right. So Dutch Brothers, they serve up coffee. They do a lot of drive-throughs. They've been public not too long, right? They've been public for longer than I thought. For some reason, I thought they IPO'd recently, but no, they've been around for a little while. And their stock sold off after the IPO, but now it's gone up nicely. The 1 year doesn't show that. The year to date, not so much. It is still a small cap, 10.4. And we have a really high PE ratio. They're growing nicely. I'm going to see if they're opening up new stores or if it's organic growth, like same store sales. Free cash flow is good, positive. See these gross margins, man, restaurants. And this is like, I put them in restaurant category. Margins are tough, man. It's kind of a business that's easy to get one's head around. Like, okay, they serve coffee and so forth, but you got to sell a lot of coffee to make a lot of money. So margins, it's got a low ceiling. So metrics. So these are the locations, I think. 670 company operated stores, 312 franchised, and they grew the store count from September to December, and they keep growing the store count. Not so much from the December 31st quarter to the March 31st quarter, but that explains a lot of their growth because you're opening new stores. So that's obviously you're going to have some sales there. So it makes that top line look better. So it's not pure organic growth. If you look at Starbucks has been closing stores in 2025. They're closing the least profitable stores, the ones that have a configuration that doesn't fit the ideal profit model for Starbucks. And they want to kind of start growing their profitability, but it's going to come at the expense, or I should say, it's going to be hard for them to grow because they're reducing the store count. That's what they're doing. All right. So Dutch Brothers overall, I don't know it's a valuation that I have, but let's take a look. Analysts, 18 of them, they think it's discounted because they're looking at earnings per share. They're not looking at cash flow. And they think it's going to keep growing nicely, probably opening new stores, and their earnings per share is going to grow. But their PE ratio is still going to stay high. I wouldn't touch this stock because it's just not an industry I want to own. I'll go to Dutch Brothers and have a cup of coffee, but I'd rather own a company like UiPath or Reddit, big margins, big potential. I'd rather own that. Or I'll pick something super safe like Colgate Palmolive. Pay me a nice dividend, go up nicely 10 to 20% a year, and we're good to go. I don't need to take chances on Dutch Brothers because this business has a very low ceiling. It has low margins. No, thank you. I'm out. And the free cash flow is tiny. If you look at their free cash flow, 65 million. Based on their growth and their profitability, if I went 20 times free cash flow, I would get to 1.3 billion. I would take away the debt, nowhere near their valuation. Not even close. I'd have them at like a 75% premium. So not my cup of tea. I'll leave that up to anybody else to invest in restaurants, but I don't have a restaurant stock right now. I don't think I'm going to have one. Maybe ever, but we'll see. All right. So thanks, Bo. Man, I hope Path comes in with 25% growth, just kills it, rallies higher. But that's just me thinking. All right. So we covered Dutch Brothers. We covered 11 stocks, and I need to cover one that was actually a request that I had taken. That's MicroStrategy. And for about a month and a half, it was a micro tragedy. Strategy is trying, they were a software company. They did analytics software. And several years ago, the founder really became enamored with Bitcoin, started a Bitcoin treasury. They issued out debt. They're going to have a Bitcoin treasury. Now the debt's beginning to force the company to have to pay out some dividends on preferred stock. And I think it got a little tense at the company. Oh man, look at that. Whew. I did not invest in strategy. I am a Bitcoin investor. But this one here, for a while, it looked like, wow, these guys really, really created something special. And investors were like, yeah, cool. Because they're using leverage to have better returns on Bitcoin than if you just own Bitcoin. Investing in Bitcoin to begin with, in my opinion, is already super risky. I'm like, I started investing 2017, 2018 in Bitcoin. So I'm doing fine, but it's risky. I mean, look at this pullback. Whew, brutal. Now, strategy got really into Bitcoin in the last 5 years. And when they started using leverage, their stock really outperformed Bitcoin. But over the last 6 months or so, it's really cratered. And Bitcoin is pretty much caught up to strategy from a return over the 5 year. And I'm still like, hey, I'll just own my Bitcoin portfolio and I'm good. Strategy, I think, is trying to do some things that may end up being quite successful. Great. But it may also get itself into a lot of trouble. And it almost got to that point. The Bitcoin did come back. Where is it at today? It's at $91,949. It was at like 80 something. 84,209. So it was 9% lower from where we're at. And from the recent high, it dropped quite a bit. So 32% from the recent high. So all this volatility really put strategy on the defensive. And I think that assured me that I'm making the right decision. I'm just going to be in Bitcoin. For all those that want to go into strategy, it's just when I invest in Bitcoin, it's really a big picture kind of investment. I think Bitcoin's a part of the future. It's a good store of value. I'll put a few bucks into it and then just watch it. And so far that strategy's played out well. I've turned a small amount into a big amount. I don't need to take any additional risk from there. I'll just keep it there. Strategy can come back. If Bitcoin goes to $150,000 a coin, strategy is going to be flying. But if Bitcoin goes back down to like 75,000, I'm still going to be in the green, but I think strategy is going to be under a lot of stress. So strategy is completely a speculative investment. And we'll see if it works for them. It really got tense. And I think a lot of other firms are trying to get all over Ethereum and do Ethereum staking and generate some income and have it resemble like bonds. And I look at it and I'm like, well, I'll just buy bonds. I know what the heck I'm dealing with there all day long. I don't have to take the risk of buying Ethereum. I've owned Ethereum. I know what it is. I know what it does. You know, if I'm going to take the chance, I'd rather just own the Bitcoin and just let it ride. So those are my comments on MicroStrategy. All right. So thanks for hanging out with me, guys. Anderson, good to see you. So, what would be software company favorite picks? You know, it is a beaten down sector, excuse me. So so we went over Okta looked really good. What are some other good ones? So I like Salesforce. I like Adobe. I like Intuit. AppLovin's kind of expensive. AppLovin's been a good winner for me. But that one was great like 2 years ago. Now it's gotten expensive. I like Fortinet for cyber. I think that one's beaten down. There's some good deals in software. And those are the stocks that I own. Some watch stocks. Monday looks good. It's discounted, but it's small company. Wix looks good. It's discounted, small. I own Zoom. I don't know that it's going up anytime soon. We talked about CrowdStrike. I think it's expensive. Viant, I heard, is going up. It's discounted, but it's been going up recently. Good to see. We talked about Mongo, but I think Mongo is a little too pricey now. And keep an eye on Path, obviously. If you see the growth in Path, man, that one's a good one. Good to see you, Anderson. All right, so last call on stock requests. And while you guys think about it, I'm going to go over one of the craziest one-day stock charts. This is the craziest one in my portfolio. This stock started the day up. At one point, it was up like close to 9%. And from there, it went down 21%. Oh my God. Talk about volatility. You get it when you invest in ALAB. And this doesn't all look all that bad. This stock is high growth, semiconductor, high profits. Really provided a nice opportunity for those who took it. Even to this point, you're doing great. But the volatility in this stock was just extreme, man. And from the recent high to where it's at now, 21.5%. Oof, incredible. So I was close to buying Astera today, but decided not to. I've got a buy price of $120. I already own the stock, and I'm just going to sit back and watch the action. We'll see how it goes. But this stock was just incredibly volatile today. Good to see you, Tony. You own Eat. Brinker. Yeah. Okay. Look at that. 181%, 1 year, 14. Nice rise recently. What are the franchises that Brinker owns? Let's see. So they own Chili's, Maggiano's. So they're sit-down restaurants. Okay. Cool. You know, when it comes to investing, if there's like an industry that really makes a lot of sense to you, you can make money at it, buying at the right times and selling at the right times. Restaurants just don't float my boat, but it doesn't mean that you can't make any money on it. You could probably make money if it really makes sense to you. Cool. Good to see you made some money on Path. Cool. I think you're maybe commenting on ALAB. It was a crazy day for ALAB, huh? Got it. Yeah, good to see you, Tony. All right, so let's see if we've got any pre-market numbers yet. Could also look at Asia. Looks like futures is trending higher. Asia looks like Shanghai is slightly higher. Japan higher. Okay. Hopefully that comes around to our side of the world and it goes higher. Yeah, tomorrow will be interesting to see how software stocks do. We had a couple announced today. Looks like CrowdStrike's under pressure, OKTA's under pressure, GitLab's under pressure. Mongo yesterday did great. Thanks, Anderson. Appreciate the super chat. But tomorrow we've got more software, especially Salesforce. Will they get credit for all their investment in agentic AI? Because they're trying to do, in a way, what Path is doing. Path is like what they do. They just do AI. They do agentic AI. They do machine learning. That's what they do. Their platform is made to help you move mundane tasks onto their platform. Then your employees are freed up. They don't have to, be dealing with tedious tasks. They can move them off to the UiPath platform. Salesforce is trying to do that as well. And they've been betting big on it. They've been doing it for a while, like 10 years. And so far, I think some customers are buying it, and the stock market's not giving Salesforce credit for it. So we'll see if it happens. In a way, we saw Google, invest a lot in Gemini, their AI business. And for a long time, the market was really just bad-mouthing Google, saying, man, those guys, they're on their way out. AI or OpenAI is just going to put these guys out of business. And the stock, over a couple year time span, it did okay. But other stocks like Meta and Microsoft were outperforming it big time. But once the market realized, well, you know what? Google's actually doing great when it comes to their AI business and their other businesses. If this type of realization happens for CRM, Salesforce, I think the stock could have a similar fate where this stock's been beaten down. I mean, 5 years up 4%, 1 year down 29%, year to date down 29%. So if we can get this thing to start working, maybe it has kind of a Google-like rally. Once the market realizes, hey, these guys are growing, they're putting a lot of money into what should be the next paradigm in software and use of data, which is AI. And man, if it starts to work, I think it's going to really go up, and I'm going to load up on Salesforce. I already own some of it, but man, it has not been fun to own Salesforce. So, all right, Salesforce, you got to come through. Don't be screwing around tomorrow. Come in with good growth. Top line growth is a must-have. Must-have top line growth. They did show something good last quarter. They went from 7.6 to almost 10% growth. Good. They can come at 11, 12%. We'll be off to the races. We will be, I don't know if it's going to be MongoDB like rally, but let's see what we're forecasting here. So the quarter that they're going to close, according to 45 analysts, they should grow by close to 10%. Their profit should grow by 82%. What is there not to like about that? They're just cranking out profit. And look at the next quarter, 74. And the next quarter, 86, 62. So very good. This looks excellent. Man, crazy market. Why is the market selling off Salesforce? Don't get it. I don't understand it. Why are they punishing Salesforce when they're growing nicely? And then when we look at their margins, right? When we look at Salesforce margins, gross margins, 77.6, 16% profit margins, 31% free cash flow margin. These are good numbers. Okay. And, but they got to grow. They got to grow. And especially if they can come loaded with, here's how many new businesses are using our agentic AI platform they call Agent Force. They show up with that right here. Salesforce, can it shake its AI curse? Dispel the rumor that AI is going to eat software. It's going to disrupt the whole industry. So, all right. We'll see which way we're going to go tomorrow. I might have to stream tomorrow because what I might do is just do a nice video on Salesforce and kick it out because I have a member call tomorrow where we bring the community together and we just talk about stocks so I can cover the Salesforce earnings tomorrow on the member call, as well as the other earnings like UiPath. In Adobe, man, I think Adobe's in the same category with Salesforce. They're growing. They're doing great margins, but the market has it in its head that AI is a threat to software companies, that the future is going to be less dependent on software. Now, I agree, like in the distant future, like 10 years from now, the way we use software is probably going to be different, better, different, and so forth. But between now and 5 years, I think it's going to be close to the same. I don't think we're going to stop, writing emails and doing stuff. I think we're going to continue to do that. And eventually it'll continue to, AI will do things that make sense. Cool. But I think Salesforce has a part of the future. It's Salesforce and Adobe, and I used Adobe software. I'm really impressed by it. Good software. They have really good AI tools. And I think those guys actually are going to use AI as an opportunity to put forward software platforms that use AI technology for the benefit of their customer, their client. The company that buys Salesforce software is going to benefit from the AI features and modules that are sold. Same thing with Adobe. Adobe is going to sell to more customers, sell at higher prices because of its AI capabilities. So there we are. Software is under pressure. We're at earnings for software companies. Now it gets really interesting. What's going to happen? What's going to happen to Adobe? Adobe's been under great stress, down 37%. Meanwhile, it's been growing top line revenue, becoming more profitable, P ratio of 20, but they're growing by like 10%. So Palantir is the future. Can't argue with that. They're cleaning up. And when we look at, when's Adobe going to announce? December 10th, a week from tomorrow. So we'll see what happens then. Last 5 days, this one's up a little bit. This one will move on. If Salesforce rallies tomorrow, these guys will rally. If Salesforce has a bad evening tomorrow, these guys are going to sell off. They're just kind of, married in the same kind of story for better or worse. Yeah, CRM is discounted. So the cash flows for CRM are excellent. The growth of Salesforce is 10%. They're already a big outfit. So on cash flows, it's discounted by 53%. On its earnings per share, just using a 25 PE, again, they're growing by 10%, high margins, 32% discount. Collectively, a 48% discount. And Adobe is discounted as well. 53% discount. So we're dealing with discounted stocks in software. Part of the reason is you've got stocks where the stock prices have been sold off. You have businesses that have gotten bigger and more profitable. When you look at like Salesforce, when the rumors or the fear began, was back here. And when we look at their business has gotten bigger each quarter. And overall, I think the market I think the market's waiting to see if how many AI use cases are really going to reach the end user where businesses are going to really start using it. It hasn't been like a quick, time to seeing it in real life, where you have, you go into to use kind of a totally futuristic situation. You walk into a Taco Bell and there's robots behind the counter making burritos and then serving you food. Now that would be physical AI. Awesome. Waymo is a good example of physical AI, but it's taken forever, man. Google has been working on that for like 16 years. It's taken 16 years to get to that point. So it takes time. It's not going to be disruptive like overnight. And that's one of the things that I like. I'm not going to bet on something that might happen in 5 years. I'm going to bet on stuff that's happening in the next 1 to 2 years. And I have to see evidence of one trend or the other. I'm seeing evidence that Salesforce and Adobe are growing. So those are solid, solid businesses that are continuing to add value. So we'll see how things play out. Michael Anthony, good to see you. DraftKings, under a lot of pressure for other reasons. Now, I didn't do deep dive on Adobe. I just showed their valuation. You didn't miss that one. And I didn't talk about Google. I think Google is priced a little bit high right now, but it could go higher, but it's gone up a lot. All right, so what else would be interesting to cover? So we talked about interest rates. Interest rates came down today a little bit, and the Fed's going to meet next week or the week after and make a decision on interest rates. It's expected that they're going to go down. So if they go 25 basis point cut, I don't think it's going to cause a big change in the market. But if they go 50, big rally. If they decide not to cut interest rates, we should see stocks sell off. That's just what happens. The market already priced in that interest rates are falling. If they don't, the market's going to want their rally back. All right, we covered ALAB. All right, last call on stocks before I turn off the live stream. Thanks for tuning in. We got a lot of people on the stream tonight. We've got 60 people on the stream. Here's something fun to do. We've been talking a lot about what's going to happen tomorrow, but I don't know if you guys look at Polymarket. Let's look at some of these stocks that are supposed to announce tomorrow. So first one was Salesforce, right? So according to Polymarket, will Salesforce beat quarterly earnings? 92% chance. How much money? 6,000. Not a lot of money on the table, but people who are willing to put money on it. Funny how quiet it is while smart money already positioned. So if I go with Polymarket, that'd be a pretty good buy. What was the other stock we talked about earlier? Was it UiPath? Let me look at the chat. I think it was Bo that asked. Yeah, Path. So let's look up Path. I guess Path isn't big enough. It's not getting any. Yeah, UiPath is not on the radar for Polymarket. But here's one that we covered. SnowFlake. Man. I think it was DJ that asked about SnowFlake. SnowFlake is supposed to rally tomorrow, buddy. 93% chance that SnowFlake will beat quarterly earnings. Huh. So SnowFlake looked good. It was a little expensive, but yeah, it is a lot expensive. But the market's buying it up. Market thinks it's going to beat earnings tomorrow. And I think what MongoDB kind of set the table for these guys. So what other stock is going to announce tomorrow? So we had SnowFlake, UiPath. Yeah, Salesforce. Okay. So that's that. What about Thursday? So Kroger. Nothing terribly big. Friday. All right. So for all you SnowFlake stock investors or anybody that was tracking it, that one is supposed to beat tomorrow. CRM stock. Here's what's interesting, right? Will Salesforce beat earnings? Yes. And the other thing I saw, will the stock go up or down? Nobody knows. $9 have been wagered. Woohoo, man. Nobody knows. They could beat on earnings and the stock sells off. Crazy. So and then somebody asked about Adobe. And Adobe should beat earnings. That one's kind of set pretty high. Huh. Okay. What about Bitcoin? Where's Bitcoin going to go? Yeah, I can't get any kind of Bitcoin price predictions. Okay. All right. So this is the Fed decision in December 10th, so a week from tomorrow. There's a 93% chance that we're going to have a 25 basis point decrease, no change, 8%, 1% chance of a 50 basis point decrease. So chances are they're going to move rates down by 25 basis points. Okay. What else is out there on Poly Market? This prediction, if MicroStrategy sells any Bitcoin to pay off some of its, I think they have to pay some preferred stock dividends. 13% chance that they have to sell some by March 31st. What's the price of gold? Okay. Second largest company at the end of 2025. So Apple, I think their chances are they're going to be there. And I guess if they overtake Nvidia would move into second place. Google's got 9% chance of getting to second place. Microsoft has a 1% chance. All those that love Tesla, a couple of them put a bid in there saying, yeah, Tesla's going to become the second most valuable company. And there's some big money riding on this. Interesting. So that is second largest. All right, here's Google. So here's kind of a different way of buying options. Where's Google trading right now? So Google stock is $316 a share. And if you think it's going to go to above 335, 53% of participants here believe it's going to go higher. And you can bet on that. And I don't know how the betting goes on Polymarket. I've never put down a bet. 30% above 345, 19% above 355, 8% above 375. And this is before year end. This is before the end of the month. Incredible. Then we got some bears saying it can go lower. Definitely can be the case. But more people believe it's going to go higher. Go Google. Keep going. Apple. So Apple at the end of this week, where is it going to close? And Apple stock right now is trading at 286. So not a lot of people think it's going to go higher, huh? No, here we go. So people think Apple stock's going to come down. So here's 285 to 290, 38% of bettors. But then there's a pretty good group saying it's going to go down a little bit. Another group down a little bit. So more bettors are thinking Apple stock's going to fade versus rise. All right. We'll see if that's the case. What about Netflix? Is it going higher, lower? Will Netflix finish week by the end of the week? Where will Netflix trade? currently at $109. Yeah, right. Netflix finished week above $50. Yes. So above $100. Yep. Above 110. That's where the real decision is. Wow, somebody above $150. Good luck with that. Oh man. So you can make bets, differently on Polymarket. They try to simplify things. Here's Palantir. So Palantir is currently priced at $170 a share. What will Palantir hit in December for the full month? Is it going to go higher or is it going to go lower? So these guys are really bullish on the stock. Up above 228, that'd be a pretty good rise. The stock is trading at 170, so it's kind of between these two. 100%, wow. That'll trade above 174. And if it's going to be below 162, so there's a fair amount of people on both sides of this one. I don't know it's going to go down this low, but there's pretty good action on both sides. $18,538 of volume being bet on that. Investors are thinking at the end of 2025, Google is going to be the third largest company and Microsoft will be the fourth. That one isn't all that controversial. All right, so NVIDIA's kind of had a weird month. Substantial sell-off. Today it had quite a bit of quite a rally early in the day, and then it faded. And I thought about buying shares. I should have. Could have caught that sucker at $180 a share. But right now it's trading at 181. And it looks like a lot of people think it could go higher. Can't argue with that. Some people think it could go lower, but more people think it could go higher. Actually, I'm going to take that back. I think more people think it could go higher. The volumes are higher. Okay. And these are like people, right? This isn't like a complicated options market where you're trying to do all this arithmetic to figure out, what's the market telling you. These are just people putting out their best guess. But this thing has Polymarket has predicted elections and things that statisticians were off. They were way out in left field, and Polymarket was correct. That was amazing. Amazing to see a new kind of crowd-based platform bring a lot of opinions together, a lot of predictions together, and then seeing what comes out. Good to see you, Anderson. Hope to see you again soon. Yeah, see you next time. All right, so I think those were the interesting ones. Oh, who will acquire Warner Brothers Discovery right now? According to Polymarket, Paramount is the favorite, Netflix in second place, Comcast in third, Amazon. Look at that. Well, Amazon already owns They bought MGM Studios, so they have a pretty good library. They got their own thing going, but maybe they come in the 11th hour, come in with a really good deal. And look who's really risen. Comcast has kind of come in lately and become a bigger player in the whole scene. No, they faded today. Sorry. They were big player, like, I guess, a couple of days ago, but it looks like they really faded. So we'll see who acquires Paramount, Warner Brothers. All right, so that's enough Polymarket lookups. Anything else worth noting on a stock investing live stream? All right, what's Bitcoin? This is what I was looking for earlier. Price of Bitcoin by the end of 2025. So we were at 91,000, I think. So we're around here. You got a good number of people saying higher. You have a good number of people saying lower, but more people saying higher. So Bitcoin might go higher. This is before the end of 2025. All right, we'll see what happens there. We shall see. F1. So Lando Norris, I think he leads Max by just a few points, right? And Max has made up some ground. A lot of money's on Max. Ooh, look at all that money. But Lando's supposed to still win. And I think the next race is going to be the decider, right? We'll see what happens. I'm not a big F1 guy. I just keep up with it a little bit. All right. I think that's it for Polymarket. So futures market up a little bit. That's good. And we've got crude dropping a little bit. Asian markets, the Shanghai is under a little pressure. Hong Kong's under more pressure. And Japan's up a little bit. Okay. Any stories on the general media? Stock market believes Google is winning the AI race over OpenAI and NVIDIA. Well, it's a good month, but let's give it some time. I wouldn't count out the other players. And nothing else there that I could see that's really important. Good thing to see Bitcoin bounce back because it could really sell off hard as it showed. But I mean, a couple years back, it really sold off. If you look at Bitcoin's super volatile, man. That's why I'm like not interested in strategy. It's like, yeah, I remember when I think the 5-year will give it to me. Yeah, right here. So here, Bitcoin got cleaned out. 74% drop. That was pretty hard. But if you hung in there, you're good. when we are having moments like this, it makes me think back of these moments. Like, whoa, this was pretty brutal. And we've had these moments, right, where this was January through April, down close to 21. So, and it looks like it had some support there. There was some buy orders at a certain price, and it kicked off a nice gain. But it's good to see it rise. What's it doing the 5-day? Yeah, very good to see it rise. I don't want to see my Bitcoin go crash and burn. Oh, man. All right, so. So my colleague Daryl does this. He calculates the expected volatility, and it looks like the expected volatility on Salesforce 7.88. So it can go up or down 7.88. So that's going to be a big swing. Where they're going to be dancing, happy, or pretty bummed out. Hopefully we're happy. I am hoping for good stuff from our friends over at Salesforce. Make it happen, Benioff. Make it happen. All right. Any last calls? Any last stocks that you guys want to look at? If you guys wouldn't mind me just telling you about the member program that I've got. I've been a long-term investor and created a lot of the tools that you're seeing when I do evaluations, and a lot of good content. And if you'd like to be a member, you get more access on live streams. If you just become a value member, you can put stock symbols that cover them. Advanced, you get access to videos. I just created one. I'm going to release it tonight. And looking at the financials sector, looking at the best and worst stocks from the top most valuable stocks, ideas there. And it came up with a couple good ideas out of that video. But that goes to advanced members. And then 30 days later, I release it to the public. You also get access to the tools that I use, Discord, and you get invited to member calls. Super investors, this is for anybody who wants to take a look at my trades that I do weekly. You get a 30-minute call at your convenience, as well as some super investor videos that it's just for super investors. And then platinum investors, more like for somebody who wants more research done. There's that program for that particular investor. Looks like Matthew, did you cover Costco headline yesterday? I think let's cover it. I think what you're referring to is that they sued to try to get that tariff money back, right? Costco is suing the U.S. government over Trump's tariffs. Here's why. So yeah, they're preemptively saying, hey, if the tariffs weren't supposed to happen, we want the money back. And that did cause a little rally because this stock hasn't been doing all that great for the 1 year. Over the 5 year, it's doing good. But if they get all that tariff money back, they're going to be able to, first, they're going to take a big, gain, but it's not like a gain that they would expect year after year. So it's going to be a gain that's put down on the lower part of the income statement. It's a one-time. And with that cash, they can buy back some shares. They can have a one-time dividend. They can do some cool stuff with it. But there's a couple ifs involved there. First, we got to let this thing kind of make its way through, I guess, the court process. If it happens, they get some money back. I think it may happen with or without this lawsuit. If it's deemed that, hey, the tariff shouldn't have happened, I think the money is going to be returned to these companies. And Costco is going to get a pretty good refund. So that would be interesting. I still think Costco's a little expensive. It's a good company, legendary company. But when I value the company, I just come up short. And I have other stocks that are in their industry that I prefer. I think the Costco stock is 34% too high. A lot of investors go into Costco because the name recognition. A lot of people like the business. They shop at Costco. They like Costco. And I can't blame them for it. You know, a lot of investors buy McDonald's for the same reason, Coca-Cola. And when you have famous investors buy Costco, like Charlie Munger loved Costco, that's a pretty good endorsement for other investors then to follow and buy into Costco. But I'll be a Costco customer, but I'm not going to be a stockholder. I have other stocks that I think are better and that are going to perform better. And I started calling out Costco as a stock that didn't look good far before, you know, when it was doing this, I was like, yeah, this stock's too expensive. And then it did this. And I'm like, all right, I guess my research had merit because there it is. The stock should be doing well. Everything else was going up. Costco went down. And I don't know that it's going to do all that great going forward either. Amazon constantly is taking market share. I think the consumer habits have already changed. We order stuff online. It's so convenient. I heard Amazon is testing 30-minute deliveries in some markets, some test markets. So you go on Amazon, hey, I want to order a toothbrush. 30 minutes later, it shows up at your doorstep. That would be impressive and just one more level of convenience. And how much market share are they going to take, right? Every time they have an innovation, it equals market share. It equals the consumer is getting addicted, accustomed to Amazon executing beyond our imaginations. Could you imagine same day delivery from e-commerce, 10 years ago? No, be nuts. If you want it overnight, you're going to pay extra. But Amazon put their network together in a way where now they have strategic distribution centers. So for major metropolitan areas, same day delivery, next day delivery, no problem. If you're in a rural area, it's a different game, right? Let's say you live in beautiful, let's say, I've been to the four corners of Colorado, so it's beautiful there. You live in Ouray, Colorado, or Durango, Colorado, beautiful. You order something on Amazon, it'll be there in a few days. You're way out there, man. They're going to have to drive a ways to get to you. But if you live in Los Angeles, New York, big metropolitan areas, you're going to get stuff delivered fast. And with that type of convenience, I think Costco will constantly have that as a pressure, because I get that you get a good deal at Costco. But man, the convenience factor of Amazon is just putting pressure on everyone. Walmart, Costco, it's putting pressure on Target, specialty retail. Amazon, I heard they are growing their apparel sales like crazy because people are buying stuff on Amazon apparel. You know what you like, the brands you like. So you just go on Amazon, you have your size, and boom, you order it. Footwear sales on Amazon are going through the roof. Same thing. It's like they're figuring out how to sell stuff and taking away market share from Costco and everybody else. That's one of the big picture threats that I see against Costco, and one of the reasons why I'm not in Costco. And they may see a nice one-time benefit from the tariff refund. Good for them. But I don't see a long-term benefit out of it. It doesn't change my thesis on Costco. I'm still out. I'm not in. But I'm in on Amazon. I'm all in on Amazon. So I do like the checkouts at Costco, the self-serve checkout, because the lines before self-serve were like, you were there for 10 to 15 minutes and it seems like forever, right? You're like, oh my God, it's taking a long time. With self-checkout, man, I'm in line for like a minute. And then I'm up to the plate, ready to scan my stuff, and I'm out. I love it. And hopefully it stays that way because it'll make it more convenient, faster, easier to shop at Costco. Good stuff. Good question. So if you guys could put in the chat, where are you guys tuning in from? I'd be interested in knowing where you're physically located. You could just give me a general area. Like, yeah, I'm in Arizona. I'm in Australia. I'm in Hawaii. I'm in Japan. I doubt that I'm going to get a lot of people in Europe because it's kind of late in Europe right now. But if you're in Europe, let me know. Be cool. Be cool to know. I always get a kick out of seeing where people are tuning in from. Washington. Very cool. Bo. So you're in state of Washington? Peru. Awesome. Bienvenido. Ohio. Cool. Good to see you from Ohio. If you're an Ohio State fan, you guys are looking good. Lining up for another championship. I think Ohio State's going to probably take the title again. They're looking pretty good. They're looking pretty dominant this year. Seattle. Beautiful Seattle, man. I've been to Seattle twice for fun. Or is it 3 times? I guess one trip, you can call it fun business. I've been there 6 times and really like that area. Michigan. Awesome. All right. Good to see you guys. I'm in California, West Coast. Dearborn. Yep. Dearborn, Michigan. Yeah, I was worried about Seattle. Somebody I worked with, he had he was a Southern California guy. He moved up to Seattle, lived there for like 10 years, and he moved back. And he said, if you visit Seattle in the summer, don't fall in love with Seattle because it's beautiful in the summer, but it rains a lot. It's gray. And he said, so just be careful. If you visit in the summer, don't fall in love and move there if you think it's going to be like that year round. And I was like, well, I guess I'll visit in the summer. Although I've been there, I was there one winter. I was actually there on business, and it was raining pretty hard. But the other trips were in the summer, and it was beautiful. Did Mount Rainier. On another trip, we took the ferries through the San Juan Islands. Another trip, we rented a really nice Airbnb on the shoreline. That was a nice trip. Been to Vancouver a few times. Vancouver is beautiful. Great area. I think growing up in a mostly, I guess, Mediterranean climate, when I go to places like that, it's beautiful. A lot of green, a lot of waterfalls, and that's something we don't have a whole lot of here. It's a little sandy, a little dry. I'm okay with that, especially in the winter time. A week ago, I had put my closet. I got to manage closet space, and I had kind of changed the inventory. I had gone from wearing shorts just about every day to, okay, well, it's getting a little cold now, so I'll put the shorts off to the kind of like the corner of the casual pants and shorts rack. And I found myself about a week and a half ago converting it back because we were dealing with 85 degrees. And it was super bright because it had rained and it was really sunny and it was kind of unusually warm. Now we're back to it gets down to 45, 50 in the evenings and it warms up to about 70 in the day. And not shorts weather. Back to a pair of jeans. So let's see here. So Bo used to live in Cali. Cool. Yeah, the other thing in Seattle is the seafood's freaking awesome. Seafood's great. Vancouver's great. You know, one place I've been to a little bit is Detroit and suburbs of Detroit, but it'd be nice to take a nice Midwest trip. Been to Ohio a little bit. Did business in Columbus. Cool people. They told me I got to go back to go to an Ohio State game. I would probably be invited to a Michigan game as well. I'm sure that's like going to Rome and going to the Vatican, kind of, which I've done, and that's like pretty damn cool. I'm a fan of football, so I wouldn't mind like going to Notre Dame, Michigan. I've been to Penn State, Ohio State, and going to, man, if I got a chance to see any football games on those campuses, that'd be awesome. In my semi on the road, sweet, man. That's cool. All right. That's awesome. All right, cool. Well, this was a cool stream, guys. We covered a lot of ground. We went 13 deep on stock reviews. I appreciate your time. Thanks for tuning in. And please come back with ideas, come back with stock requests. Bring all your stuff. Let's figure out how to invest and beat the market next year. And just a quick reminder that this year, especially, retail investors are beating the institutional investors because we're doing our own homework. We're getting better. We know how to value companies. We know how to invest in companies. We don't need to pay somebody a bunch of money to manage our money and probably not really care as much as we care about our money. We care about our capital. And at the end of the day, we do better when we manage our own capital. We get a better skill set. Years later, we become better at it and make even more money and establish economic freedom for ourselves, right? So just a quick reminder, I like to remind us of that so we can keep the kind of like the effort. And on down days, pick yourself up because there'll be some down days. There'll be some real soul crushing years like 2022 or even the COVID year where, man, stock sold off. But we just got to understand that over time, we're going to do a lot better. I can tell you firsthand that it's been something that I wish I would have done it more at a younger age. I did do quite a bit, but man, if I would have put the time that I'm putting in now when I was 22, I would have at least made $2 million more. And, but I'm glad I'm at where I'm at. But I would just say if they're whatever age you're at, all the time you put into it, it's going to pay you back big time. Do you think robo investor not good? Robo investor. I don't know what you mean there. Can you give me more, Bo? Do you mean Roblox? So Okay, so you just have like use it with SoFi on your 401k, and I'm not familiar with it. So Robo Advisor, I think you're making selections like you're telling it what your preferences are, and then it makes suggestions for you, and maybe it buys into ETFs that align with that. Yeah, picks a bunch of ETFs for you. Okay, so here's how I'm going to answer it. So when you're getting off the ground kind of early in your investing game, ETFs are really good. And I would encourage you to have a part of your portfolio. Let's say you're brand spanking new to investing, just started, and you don't have a lot of experience. So you've worked really hard for your money. So here's a suggestion. You pick a majority of your fund. Say you have 50 grand, and a majority of it goes into these ETFs that align with what you want, which is, hey, you're 35 and you want growth. You want to grow. You want to grow that capital into something bigger. So you would have ETFs that align with growth in areas that you believe in. Like, hey, I think technology is going to keep getting bigger. You think other industries like financials would be good. So you have some ETFs there. And grab a portion like 10% and start investing in individual stocks, but start to form a skill set around understanding industries, right? So we have in the economy are different industries. You have companies that are creating healthcare products, services. You have companies that are creating energy, oil, natural gas, that are creating utilities like electricity, real estate companies, and so forth. And as you assess, okay, well, what could I invest in, right? Is, start in places that you find familiar. Like, hey, I interned at Comcast. Okay, that's in communication services. You probably have some knowledge there. Try to use that as a place to start and get to know communication services. How do those businesses run? And then get into the financials. How do the financials for communication companies like Comcast look? Because you know the business, you know how it runs, you know what kind of revenues they have. Now you look at their income statement, balance sheet, cash flow, and you look at them, it's almost like opening the hood on a car. You know that the car runs. You go in, you push the button or turn the key, it turns on, you put it in gear and you drive. So theoretically, you know what it does. But when you open the financial statements, you're opening the hood and now you're seeing the engine. Maybe you notice a transmission. If you take the wheels off, you look at the brakes and so forth. When you get down to this level, now you're understanding the business better. And you start building a skill to be able to say, is Comcast a good business or is there a better business within communication services? And trying to get to a level of knowledge and ability to be able to decipher which is the best stock within this industry. You don't have to boil the ocean. Just pick industries and sectors that are familiar to you wherever you're at. Start doing some homework. Don't be afraid of effort. You can learn. You can learn from my channel. You can learn from other channels. You can learn from Gemini, ChatGPT, Perplexity. Every question that you can want to know the answer to from a finance perspective, it's available. It's available on Gemini. And just start building a skill set, because if you're an ETF investor for 30 years, you're a passive investor. You're going to wake up 30 years later and you're going to be like, I invest into ETFs. Okay, cool. It's like investing in the economy. Nothing wrong with that. That's what you want to do. That's cool. But if you start really playing, or I should say, investing and practicing in individual stocks at some capacity, you're going to get better even at ETF investing, because you're truly now understanding what moves stock prices. What does a really good company look like? You want to see great? Look at NVIDIA. Look at Google. Those are the examples. Now we got to go find companies that are small that are going to grow into that. Okay. So robo investing is fine, especially if you're limited on time. You might have a young family. You might have a very demanding career. You may just have a year where you're like, I just need time to do something else. Cool. Because the stock market will always be here when you come back, and you put stuff on, ETF, robo investing. That's cool. But as much as effort as you put into becoming a good investor, like anything, you're going to get good at it. And some of these lessons will stay with you for the rest of your investing career. So that's what I would say is robo investing is good, especially like in your working days. You're probably putting away, a part of your salary goes in, and you're automatically allocating, because that's really what they're doing. You're automatically allocating to certain ETFs. That's great. That's great that you do that. Just when you want to, again, work on your skill set, boom, you can do that. It'd be like being an ETF investor is almost like, pick the sport. I'm going to pick baseball. Let's say I'm a Los Angeles Angels fan, and I could be a really good fan, sit in the stands, get good seats, and root on the team. And if they win, I'll feel good. If they lose, I'll feel bad. Owning ETFs is a little bit like being a fan. Going individual stocks is almost like, you're trying out for the team. And if you're going to get better, you're probably going to be a better ball player if you try that. You're probably going to understand the game better. It's going to be hard. It's going to be much harder than being a fan. But at the same time, what do you want? What do you want out of stock investing? Do you want to be fully capable of picking great stocks and, going through the kind of like the victories and the losses, and just having a sense of, hey man, this is really interesting. It's very worthwhile. It's very demanding, but I think it's a calling for a lot of people that want that type of challenge. And there's a lot of great stories of people that do great things with stock investing. And that's what I would leave you with there with stock investing, robo investing that firms are probably putting out there. But overall, if you're saving money, you're doing the right thing. And I'll always share like reflection points. There was some rules of thumb that I learned at an early age that I wish I was never taught, like invest in bonds. When I was like 25, I was hearing these rules of thumb. I wish I hadn't heard those, because I did follow them, and it probably wasn't the rate of return that I could have had if I would have followed my intuition, which was technology stocks. That's where it's at. So I'll pass that along. The other thing is, the sooner you really get really deep into learning, the quicker you'll learn, and the more you'll open up kind of the ability to understand things within companies, stocks, the market moves, the market hype, the market emotion. The quicker you'll understand that. And then, you can spend a half hour a day, an hour a day, and you can be great. You can spend more than that if you find it entertaining. But it's not like you have to work on it for 12 hours a day. It's not that at all. You can start with a small portfolio, 4 stocks, 5 stocks, 6 stocks, eventually, build it as you see, you can logically manage and do the research on. Maybe 10 years from now, you find yourself with 25 awesome stocks, or maybe 25 stocks, 15 of them you think are awesome. 10 of them, you're still trying to figure out if they're going to be awesome or if they should be sold. Just putting a little reality in that statement. Cool. Good question. Thanks, Bo. I appreciate your support. It's great to have you on the streams. Thank you. Okay, so that'll be it, guys. Good stream. Thank you for tuning in. I'll be back with Daryl tomorrow morning, and maybe I'll see you. It'll be at 9 a.m. Eastern, and then I'll stream again on Thursday, and maybe I'll see you then. Thursday evening, and you can catch me on the evening stream on Thursday. Have a terrific night. Take care, everyone.